Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Ian, welcome again this week.
Thanks, Don.
Making money in stressed capital markets situations is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Today, Ian is here again with Siberia Capital's latest press release. Ian, USD Wrecking Ball, currency and risk assets under pressure as USD strengthens 5%. What does all that mean?
Well, it means the dollar, flight to safety due to the Iran war, has caused risk assets to break. They were kind of in a bubble, so probably due to break, especially gold. Bitcoin's been absolutely hammered, now down 50%. Gold down 30%, silver down 50% as well. But currencies are sliding. As we saw last week, yen and Canada under a lot of pressure. Indonesia are forced to have an emergency rate hike meeting, or emergency meeting and hiked rates to support their currency this week. So a surging dollar is the last thing anybody wants, particularly the United States. But unfortunately, that's where in times of safety requirement, that is normally where it goes. That's what's been happening.
Anything more? You mentioned in your press release about Kevin Walsh's first press conference, and your views were that he was being hawkish, but you're now not of that opinion.
I didn't think he was being hawkish. I think Mickey last week thought he was being hawkish. I thought he was just trying to be credible in a organisation that hadn't been credible for a long time. So, he said, the only thing we're going to do is sort out inflation, and we're going to do the right thing, and we're going to be, transparent and honest and all this sort of stuff. Exactly what he should be saying. In fact, exactly what we should be assuming by default it's going to be like, right? He shouldn't have to say it. And the fact that Trump backed him up by saying that the money that they've stolen from Iran is actually Iran's. Who'd have thought? Right. That's all part of the beginning of some sort of monetary reset, because if there's going to be a big change, then it has to be done with the US dollar being credible. And so
if let's go and ask Ian, if they're rebuilding credibility, does this mean markets should expect fewer rate cuts than previously priced?
Yes, and that's exactly what's happened. In fact, markets are now pricing in 1 or 2 rate hikes the rest of this year.
Right. Okay.
And as you remember, the bubbles have been built on at least the assumption of lower interest rates in the future, and the assumption of quantitative easing to get everybody out of any trouble that occurs. So now those two things have disappeared because Walsh is resigned from the Fed in 2009, I think it was, because of the QE stuff. He didn't agree with it. Yep. So there's no longer this narrative behind markets that the Fed is there to help them. In fact, he said specifically, we're here to listen to markets, not help markets.
Right. Yes. You've also mentioned about the US 10-year yields falling 15 basis points. Is this the bond market signaling lower inflation risk, slower growth, or is it a policy mistake?
I think it's signaling that the markets now think that the Fed is doing, the bond market, shall we say, thinks the Fed is doing the right thing, i.e. it's looking at potentially hiking rates because that's what needs to happen. So it's the credibility thing as well. So whereas short end goes up in terms of yield, the long end has come down now. which is a good thing because it's those 10-year rates that need to come down lower. I mean, I say it's come down lower. It's come down 6 points, so not much, but Walsh didn't spook the bond market, which is great.
You also mentioned about investors questioning the debasement trade, whether Bitcoin can actually go to zero, and global valuations. Is this a serious macro risk or mainly a sentiment reset?
I think it's actually a result of the fact that markets have been hammered. So, can gold go to zero? No. Can Bitcoin go to zero? Yes, absolutely. We've had some IPOs. SpaceX is back at the price it IPO'd at. We all know that valuations are stretched beyond belief. And now the Fed's taken itself out of helping markets. So investors are questioning where their capital should be deployed.
And you've said that at the top about that as well. You've mentioned also about the Australian Labor government's axing of tax breaks and blatant tax grab has turned the population's complacency into mindfulness, and Australia should heed the UK's recent history. Are voters losing tolerance for higher taxes and weaker living standards?
That's a big question. So, in regard to Australia, I guess I was following on from the narrative that markets have been in a bubble, Fed got their back. Australia has been in this bubble for a long time with the housing market. And now that bubble has been popped by the federal government. Whether they intended to do that or not, it has popped. And we're now looking at negative house prices in all states pretty much at the moment, with Melbourne being, I think, particularly bad. Who knows what it's going to be in the future, but sentiment has changed on a dime. Before the budget, everybody thought house prices were going to go up forever. Now that sentiment has changed, and I think there's quite a lot of fear in the Australian public because it's, the public is so leveraged to property. It's unbelievable. The most in the world, I believe. Highest debt, highest household debt per capita is in Australia, where we have the highest house prices that can reverse quite a lot very easily without really meaning we're going to bear market or anything. And of course, following on from the UK, where there's a new prime minister again, 10 in 6 years, or is it 6 in 10 years? I can't remember. But
probably 6 and 10. Yeah.
Yeah. There's even. Have you heard of Larry the cat?
Who's Larry the cat?
It's Downing Street. 10 Downing Street has a cat called Larry.
Yes.
And because of all the prime ministers that have been through the doors recently, someone's given Larry the cat a social media account. And Larry sits outside Downing Street, but someone's put in a revolving door this week. So
Right.
So people are having a lot of fun with that.
I'm sure.
But in the UK, cost to the government of their obligations in terms of healthcare, social stuff, is now higher than the tax base. So Britain is literally insolvent. We've got a Labour government that pursued lots of very left-wing socialist policies. The population is really angry. I can tell you that in England, which I haven't seen in my lifetime. And my comment is that from Australia's perspective, we seem to be going down that path. In that, the country that I moved to 20 years ago that had a surplus is now over $1 trillion in debt. It's unbelievable.
Yep. Not good. And as you pointed out in your release, Australia's only 5 years behind, so it's going to be fairly quickly getting here.
Well, we've already got, woke policies. There's no one that has been Chancellor of the Exchequer in England or the Treasurer in Australia that actually has experience in finance. No wonder we're in trouble. No one's even run a business, let alone been in finance. Originally, the Chancellor of the Exchequer was meant to train at the Treasury for 7 years, but that seems to have gone out the window.
Well, it all sounds a bit dire. I'd be interested to see what those charts of yours look like this week. Was there anything else before we moved on to those out of the release you wanted to cover?
Only that economically, we've got European CPI this week. So the EU hiked a couple of weeks ago. And we've got non-farm payroll in America before Independence Day, which is actually on the 3rd, Friday the 3rd, and July 4th, obviously, next weekend. So we've got some news that might upset markets with non-farm payrolls and CPI in Europe. Yeah, so should we go and have a look at the charts then?
Yes, let's do that.
All right. So going from left to right as usual. Bitcoin has obviously been in a long down spiral and it's treading water. Gold, pretty much the same, but not so much. This is only 30% rather than 50% in Bitcoin. So these risk assets denominated in dollars are being wrecked by a stronger dollar. Whereas currencies, the move that we talked about last week seems to have stopped at least in the last couple of days. So this is the dollar going up. Again, this is a futures contract against a basket of currencies. This is dollar yen in particular, where we are now at 162. 160 was where the Bank of Japan has been intervening 3 times in the last 4 years, I think it is. Dollar Canada, okay, it's kind of stopped, but it's still pretty much a wrecking ball. And the rupiah, that's the rupee, sorry, the Indonesian rupee, when they hiked rates, that has seemingly had its run. 10-year yields are coming lower. You can see that we were in a sort of wedge pattern that had to break. And we tried breaking high, but we couldn't. So this is back at pretty much the same rates as when Trump came in. So over a year and a half, they haven't been able to get those rates down. Even though the Fed has cut rates 3 times, market rates haven't come down at all. This is why I think we're suddenly having a big focus on credibility and, confidence in the dollar, because we've got to do something about these rates because it's costing a fortune to maintain the debt. Most of the hot money that has gone out of Bitcoin and gold has obviously gone into the Magnificent Seven and all the chip stocks, but we're, as I've dramatically put here in the S&P, we're going into a wedge pattern here where a big decision will be made at some stage near. The Nasdaq is more bearish in that we've tried going down and we bounced and we're coming back down again. And I think that the bellwether probably here is the Dow Jones at the moment, because there's not so much hot money in it, and these long candles tell us the market has tried to rally but can't rally any further. And this is SpaceX for the couple of weeks since it IPO'd, and as you can see, we're back to basically where it was in the first day. So anybody that's bought it so far is either flat or has lost money. So a steep drop in it would be very negative for markets and would make all these other IPOs that are coming out very difficult to run, because there's a whole load of them in succession. So I suspect Wall Street is really engaged in keeping this price up at the moment.
Yep. Yeah, it's in their interest, basically.
That's right. So that's really all for the charts for today, because it's been fairly quiet over the weekend. I noticed that the US, for the second day in a row, has been attacking Iran, despite fire and all this stuff. So markets are ignoring that at the moment, because they've got other things to focus on, like inflation. But of course, that can come roaring back in importance if something happens.
Right. Okay. Very good. Nothing more before we wrap up then?
No, I think that's all. I mean, we're just waiting for more wash, any monetary reset, or some sort of direction around that, and we're watching really what the stock markets are doing in America.
Yep. All right. Well, thanks again. Very enlightening. Very, very well presented. And thanks again. So that's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website, or alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Thanks again, Ian, for your presentation, and thanks everyone else for listening in.